So friends, now we start section 17. This is talking about apportionment as well as blocked credits. Blocked credit means there are certain supplies for which credits are not available. Okay, so now we'll take up section 17. This has got 6 subsections. So here I'll divide that mainly in 3 parts. This is apportionment. This is exclusively for banks, financial institutions as well as NBFCs, and this is blocked credits. Okay, so friends, blocked credits are covered in subsection 5, and there we have clause number A to clause number I. So 9 clauses, but lots of other entries are also there, right? Now in apportionment, the question of apportionment arises only if we use the goods and services for business and non-business purposes, and in business also for taxable as well as exempt supplies. Then comes the question of apportionment. So if there are goods and services which are used exclusively for the taxable supplies, the question of apportionment does not arise, right? So now in apportionment, the first question is this way: goods and services for business, and those are used or intended to be used for non-business purposes. And if those are to be used for non-business purposes, question of input tax credit does not arise, right? In case of goods and services which are used for business, this we will divide it in 2 parts. These are for taxable supplies plus zero rated supplies. Taxable as well as zero rated, and here we have other exempt supplies. So I have used the word other exempt because zero rated are otherwise covered in the definition of exempt supplies. So that's why I am using the word other exempt. So other exempt are those are non-taxable or those are taxable but exempted. Oh, both the things are covered therein, right? Zero rated also comes in the category of other exempt, but here that is covered here in the case of along with taxable. So for this credit is available. For this credit is available. For this credit is not available, right? But now the question comes, how to decide in what ratio the goods are going to be used for taxable as well as zero rated as well as for exempt supplies. So in this case, first we have value of exempt supply as prescribed. So out of the total supplies, how to compute the value of exempt supply, that is going to be prescribed, right? and how it is going to be prescribed. So this is subsection 3. This portion is subsection 3. This is subsection 1, business and non-business, and in subsection 2 we are talking about taxable as well as zero rated supplies, and we are talking about other exempt supplies, right? And how the apportionment is to be done. For the purpose of apportionment, this will go this way, and here we have rule number 42 and 43. These are the rules which prescribe about apportionment. These two talk about how to be apportioned. So credit will be available only for those goods and services which are used in business, and that too for the taxable as well as zero rated supplies. So if we have certain goods and services which are common for taxable supplies as well as other exempt supplies, then there is a proportion. So the credit will be available only in proportion of the uses for taxable supplies and zero rated supplies. But how the apportionment is to be done, that is, for that we need to refer rule number 42 and 43, right? Now as far as banks, financial institutions are concerned, this is covered in subsection 4, right? This is subsection 6, that the government is having a right how to prescribe. So effectively the section is having 6 subsections, so everything is covered here. Subsection 1, 2, then we have 3, then 4 is there, 5 is there, and 6 is here. So everything is covered in one chart, and if you remember the chart, entire section 17 becomes very easy for you. As far as banks and financial institutions are concerned, they have been given 2 options. I am giving it title option 1, and here we have option number 2. So they have 2 options, either go as per option 1 or go as per option number 2. Option 1 says you can adopt subsection 2. So this is go as per subsection 2. Subsection 2 is already mentioned here, right? So if you want to go as per subsection 2, good enough, then the apportionment has to be done as per rule number 42, 43. Otherwise, 50% credit on capital goods, input and input services. Choice is yours, whether you want to go for this or you want to go for the second option. But once the option is taken, then it cannot be changed for the financial year. Cannot be changed for financial year. So option can be exercised on any given day, but once it is taken, then that option cannot be changed for the financial year. And the details of this we will talk about in rule number 38. So this is rule number 38, and here we have rule number 42 and 43. So this is entire chart. Here I cannot list that in short, so this I am leaving blank. I wish you to prepare this chart in double spreadsheet, so later on you can fulfill those 9 clauses also here. So this one chart will help you to understand entire section 17. Okay, rules we cannot write on the same page because every rule requires a detailed calculation and detailed understanding. So rule 38 is very small, but rule number 42 and 43, these are long rules. So once again let me explain you. Section 17, this talks about apportionment as well as blocked credits. Question of apportionment arise only when we use the goods and services for business, non-business, and in business also for taxable as well as exempt supplies. Then we have a specific provision in relation to banks and financial institutions, and then subsection 5, that is about the blocked credits. And blocked credit means for the goods and services for which credit is not available. For the banks and financial institution, first option given to them that you can adopt subsection 2, which is for avail the credit in relation to the taxable supplies and don't use for exempt supplies. Otherwise, for every month, whatever credit is available, then only 50% is usable and balance 50% will lapse. Apportionment, This says credit will not be available for the goods and services which are used for non-business purposes, and in business also credit will be available for taxable as well as zero rated supply. So here I can use the word and. So taxable and zero rated supplies, and here we have other exempt supplies. So other word I highlighted, reason being because zero rated supplies are covered in the definition of exempt. So that's why I have specifically give you other exempt supplies, right? Then subsection 3 says how to determine the value, because the proportion has to be done, and then that we are going to discuss in detail in rule number 42 and 43. Subsection 6 says that how to do this entire calculation, that will be prescribed by the government, and that has been given in rule number 42 and 43. Okay, so I hope you have prepared the chart along with me, and if you have prepared in one side, please make it again on the double spreadsheet, right? But that you can do later once we have completed the chapter, or rather this section along with rule number 42 and 43, right? So right now, first of all, we'll go to rule number 38. So now we are starting with rule number 38. And this is exclusively for banks, NBFC, financial institution. Their main business is accepting deposits and extending loans and advances. For them, input tax credit as per this rule not available, and then available, right? The credit is not available for goods and services used or to be used for non-business purposes. And number 2, supplies referred under section 17 subsection 5, which are referred as blocked credits. So any bank or financial institution or NBFC that shall not avail credit in respect of the goods or services which are used or intended to be used for non-business purposes, and it shall not avail any credit for the goods and services which are referred under section 17 subsection 5, right? Now it is available for all other supplies of goods and services. So when filing the return, they will fill up the information about the full amount of the tax, but 50% of that will be credited to their electronic credit ledger, and 50% of tax charged is credited to electronic credit ledger, right? This is important that 50% of the tax charge will be credited. But one more thing, when the credit is transferred from another place of business, and it will be only in case of input service distributor, then it will not be reduced by 50%. So I can put a note, when credit is distributed by ISD, full credit is available. Reason being, because when the credit is availed by the input service distributor, for him also the same provisions are applicable. He has already got credit of that 50%, and when he is transferring out of that 50%, it will not be further reduced by 50%. So this note is relevant there, and this is rule number 38. So this is exclusively for the banks, financial institutions as well as NBFCs. And first of all, it is saying that the main business of these are accepting deposits, extending loans and advances, that for them credit is not available for the goods and services which are not used or intended to be used in connection with the business. If those are used for common, that is taxable as well as non-taxable supplies, this is the provision. So this is simply saying no credit for the goods and services which are not used in relation to business, and supplies which are registered and which are covered under section 17 subsection 5, which are blocked supplies or blocked credits. For all other credit is available. So the question of 50% is given only because in the case of banks and financial institutions, majority of their supplies are covered in exempt supplies. So that's why, rather than going into the exact calculation of how much is what is the value of the exempt supplies and what is the value of the taxable supplies, the simple formula given to them. So this is an option. We have already referred that in subsection 4, that this is an option, and if they exercise this option, then 50% of the credit is available for utilization for discharging their liabilities, and balance 50% of the credit will lapse. So this is rule number 38. Okay, now we move to rule number 42. Now as far as rule 42 is concerned, that is in relation to inputs and input services. Rule number 43 is in relation to capital goods. Okay, so here we have rule 42. This is for inputs and input services, and for that we can just have a look, because I have written slightly upside. Let me clear it. So this will be rule number 42. This is for input and input services. And then comes rule 43. This is for capital goods. Okay, so first of all, this is the distinction. Rule number 42 is for input and input services. Rule number 43 is in relation to capital goods. This is rule number 43. So the topic of discussion now is rule number 42. How much amount of credit will be available for use? Credit is available for the amount which is what is the amount of the tax paid, but what is usable, that is important, that is the apportionment. So earlier I told you the question of apportionment arise only when we use input and input services for business and non-business purposes, as well as for taxable as well as and exempt supplies, right? So when the rule becomes applicable, we use input and input services are used for business and non-business, taxable as well as exempt supplies. So unless this mixture of the uses is there, this rule has no relevance, right? So somebody who is exclusively engaged in taxable supply only, this rule has nothing to do. So when there is a business and non-business as well as a taxable and exempt supplies, only then this rule becomes applicable, right? Now how much amount will be credited or will be available? For that, we say the amount which is credited to the ledger, that is referred as C1. Amount credited to electronic ledger, this is called C1. This is equal to T minus T1 plus T2 plus T3. So amount credited to ledger, this has been given a name C1. C1 is equal to T and T minus T1 plus T2 plus T3. So T is total tax on inputs and input services. That is the total amount of tax. T1, this is tax on inputs and input services used exclusively for non-business purposes. Used exclusively for non-business purposes. T2, this is again tax paid or tax on input and input services used exclusively for exempt supplies. Right? So now you understand that credit is not available for the input and input services which are used for non-business purposes. It is not available for the exempt supplies. Right? Then we have T3. This is tax on inputs and input supplies covered under section 17 subsection 5. Okay. So effectively what you are saying is that how much amount is going to be credited in the ledger, that will be total tax on all input supplies minus tax on the supplies which are used exclusively for non-business purposes. So underline the word non-business. This is exempt and this is blocked credits, right? So amount which will be credited to ledger, this will be equal to total tax on input and input supplies during a tax period, and this tax period is certainly a month. So whatever calculation we are showing you here, same thing has to be done for monthly basis, and after the end of financial year also that same calculation has to be done once again to determine whether whatever is done throughout the year is correct or not, and then adjustment is done later, right? So this is amount which is to be credited to ledger is equal to total amount of the tax which is on input services minus tax on the input services which are used exclusively for non-business purposes, then exclusively for exempt supplies, and then we have tax on input services covered under section 17(5). So first of all we calculate this amount, that is amount to be credited. Then we have another entry which is called T4. This is tax on input services used exclusively for taxable supplies plus zero rated supplies, because in case of zero rated credit is available. So T4 that is not used here, so that we are going to talk about now. So first calculation is how much amount is going to be credited in the ledger, that is total tax on import supplies minus the tax on the supplies which are used exclusively for non-business, exclusively for exempt, and which are the supplies which are covered in the section 17 subsection 5. Then we have T4, this is the supply which is used exclusively for the taxable supplies as well as zero rated supplies. So everywhere you have to understand that this is exclusively, this is also exclusively, here also exclusively, here also exclusively. Now we have certain supplies which are used here and there both. Right, here and there means for business, non-business, for taxable as well as exempt, so which are common. So here we are talking about T1, T2, T3, T4 which are used exclusively. Right, so you have 4 types of items, right, and rather 5 types of items, right. One is used here, one is used here, this is here, this is here. Now we have another type of articles or another type of services which are used at both the places. Right, so that also we need to find out. Right, so that we will call as a common credit. So common credit, this we will refer as amount C2. Right, so how to find that C2? C2 is equal to C1. C1 is here, right, minus T4. So here we had the credit for the supplies other than non-business, other than exempt, other than blocked credits. Now out of that also we have reduced the supplies which are exclusively used for taxable as well as zero rated supplies. So now we have common credit. Now out of common credit we need to divide what is used in relation to zero rated supplies and what is used in relation to exempt supplies. So this is needed to be bifurcated in 2. So now common credit, this has to be divided now in 2 parts. This is for taxable plus zero rated supplies and for other exempt supplies. Right, now for other exempt supplies, this we will divide as, this is called as D1. So D1 is equal to E divided by F multiplied by C2, which is common credit. Okay, so now how to do that? So D1 is the amount of credit, common credit, which is used exclusively in relation to exempt supply. So this is other is again having the same meaning because zero rated has been covered here. So E is value of exempt supplies but this exempt, then we have turnover in the state, because calculation has to be done for every state separately, and then we divide that, multiply that with common credit. So this way we will find the proportion of the credit, common credit, which is used in relation to exempt supplies. Right, so here we have value of exempt supplies divided by total turnover in the state. Right, because this zero rated supply includes zero rated also, so we need to calculate zero rated separately also, and that we will refer as D2. So D2 will be used for non-business purposes. So here we have already found zero rated exempt supplies. Okay. Now some of the common credits will also be used in relation to non-business purposes. So when we have common supplies, for non-business, this is taken as 5% of C2. So out of the common credit, we will take 5% value of that. So out of that common credit, what amount will be credited in the ledger? That is called C3. C3 is equal to C2 minus D1 plus D2. This is called D2. So how much amount will actually be available for uses? So that is equal to T4 plus C3. That much amount will be available for uses by way of credit. So this calculation is to be done every month for the taxable period, right? So only amount which is T4 plus C3 that is available by way of credit for uses. Balance amount has to be reversed by adding in the monthly liability. So why it is added in the monthly output liability? Because first of all, credit has been given, and now the amount which is other than C3 and T4, that has to be reversed by adding in the monthly liability. So when it is added in the monthly liability, no interest is payable. Now when the financial year ends, we do the same calculation again, and that is for the whole financial year. And then we have to see whether the amount which is required to be reversed for every taxable period is more or less than what is done for the entire year. And if it is done less, then differential has to be done before the end of September for the next financial year, but in that case interest will also be payable. And if it is excess has already been reversed, then for balance credit can be taken up to the date of filing of the return for the month of September of the following financial year. So when the financial year ends, the entire calculation of that C1, C2, C3, C4, everything has to be done again for the whole financial year. And then the amount which is already reversed during the financial year and the amount which is required to be done on the basis of financial calculation for the year, that we have to compare. So when we compare with the annual calculation, there are two possibilities: that the reversals already done during the year on monthly basis, those are more or less. So if those are more, credit can be taken up to the month of September. But if those are less, then the differential amount will be added in the monthly liability for at any time until the month of September when the calculation has been done. And when the reversal is done for the excess amount, then interest is also payable. So during the financial year, no interest is payable for making the reversals, but after the end of financial year, if any differential amount is payable, on that interest will also be attracted. So this is rule number 42. Read it carefully before proceeding to rule number 43. For the remaining for rule number 43 as well as subsection 5, we will talk about in the next video.